On the 22nd of November 2017, the UK budget hinted at some changes that could affect investors in enterprise investment schemes and also venture capital trusts. Chris Boxall joins us now from Fundamental Asset Management with a look at just how this could change the landscape for us. I know that you specialise in AIM stocks. Explain more about how this could affect investors.
The concern is that the issues that are going to attacking the EIS and VCT could be potentially looking at business property relief as well, and not just the rules governing EIS and the VCTs. And it's true, many have worried for a while that the business property relief rules are becoming potentially a little bit over generous. I mean, it's possible now to have relief by investing in a company the size of ASOS, 3 billion market plus, or a 4 billion market cap business, and still benefit from business property relief just because it qualifies and is on AIM. And I think these are valid concerns, really. And our firm participated in the patient capital review, which was submitted to the HM Treasury, and there are grounds for tightening up the BPR rules, in our opinion. We don't think they were established to protect investors in certain types of company.
Now, over £100 billion has been raised by AIM stocks, I think, since it started back in '95. I think $5.5 billion this year alone, I think, in 2017. Yeah. Are these rules going to change the amount of money that investors or companies are going to be able to raise? Is the attitude towards AIM going to change?
It is a good point, and that is a risk. It could change the attitude for fundraising and the appetite for investors, because the BPR rules have attracted a lot of inheritance tax money to AIM. Increasingly so with the ISA rule changes as well. You can invest in qualifying AIM shares within your ISA. And the massively improved quality of AIM over the last few years has seen a growing sort of wave of inheritance tax, IHT money come to AIM. And we feel, yes, that there are bubble concerns in some areas because of that. And should it be right that all companies have the same BPR attractions as others? Are all companies on AIM born equal, or all qualifying companies born equal? That's not entirely fair in our opinion. You could also say, we don't think, also on the other side, we don't think investors should necessarily be punished if you've held a share for a long time and supported what is now a huge company. You shouldn't necessarily be punished. I mean, if you've been an investor in ASOS for the last 10 years and bought it at a time of high risk, should you really be punished now just because it's a 4 billion business? That's not necessarily the case.
So how does the government get out of this position then? Does it flag in advance what it wants to do, and it'll take certain companies that no longer qualify out of the schemes?
I think the underlying legislation is difficult. However, we feel that there are obvious areas that could be curtailed a little bit, restricted, and notably overseas companies. And I don't just mean the overseas registration, because at the moment the domicile of the company is of a little relevance. You could be domiciled in whatever, the Cayman, but if your operations qualify, you still qualify for IHT planning purposes. However, if you are domiciled overseas, you don't pay any UK corporation tax, you don't employ anybody in the United Kingdom, you're no good whatsoever to the UK economy, quite frankly, other than offering maybe a product that UK consumers might like. Where's the benefit?
So the point is the taxpayer shouldn't have to foot the bill for those sort of companies. So when the ground does change, how does the ordinary everyday investor find out about this?
Well, already the investors in qualifying AIM companies should keep a regular eye on their holdings. They should really keep a close eye, because the qualifying status of AIM companies changes all the time anyway. Companies, if they hoard excess cash, if they sell off subsidiaries and hoard cash, if they suddenly turn themselves into investment companies, unwittingly, if they start making passive investments, those keep growing and growing and growing. Conceivably, their qualifying status, well, to be precise, their qualifying status as a whole won't change, but they may have what's called accepted assets, so they may not qualify in their entirety. So one has to keep a close eye on what's going on. This will just mean you've got to keep an even closer eye. And there are prime examples of companies that...
Such as?
Well, One star, and look, it's a great company. It was Strix Group. It's recently listed, and we've commented on it before. It owns the IP for kettle controls. You know, the thermostat, the controls that switch off kettles. It's got a fantastic market position. However, I think it's domiciled in the Isle of Man. All its products made in China. It pays no tax whatsoever, I don't think, other than a tiny bit in China as a result of its operations there. And it arrived on AIM following a restructuring of private equity ownership. There was essentially no new money to support growth in the United Kingdom, as far as I can see. It was simply money to pay off the previous private equity owners. You know, I don't necessarily want to pick on Strix, and there are others. There's one in our portfolio, conceivably. It doesn't do a lot in the UK, but tax should be give and take. I mean, if you're getting a big tax benefit, there should be tax surely payable spewing out the other side to HM Revenue and Customs. Here, I don't see any little benefit. Let's see, he's doing all right out of it, so conceivably there's a tax take in there. Yeah. But that's it.
Yeah. Okay. All right, Chris. Look, thanks so much indeed for updating us on the potential changes, possibly to those that are invested in the AIM space. That's Chris Boxall from Fundamental Asset Management. Subscribe to IG for educational content, company insight, financial analysis, and expert commentary. Or visit our website for daily market updates, trading ideas, and strategies.